Thank you for coming to the Financial Almanac. I'm your host, Basil. In a few minutes, we're going to see the FOMC, which is the Federal Reserve Chairman Jerome Powell, announce whether there'll be a hike rate or not. We do not know for certain if this hike rate will happen. As of right now, there's several divisions of the Federal Reserve. There's one in Atlanta, one in Boston. There's a few around that sort of come to a consensus and usually vote. And we see on this dotted chart that will they pass 0.25% or will they not? So let me know before we get to that part of the video down below. What do you think will happen? Will the Fed raise interest rates by 0.25 or will they pause and not increase interest rates? In today's video, before we check up on what Jerome Powell will do, we're going to review what other presidencies of the Federal Reserve banks across the US are going to be expecting. What I'll share with you is what these markets are expecting and what my personal opinion is. So this is very crucial because the financial market, the credit market, the lending market, the borrowing market, the crypto market, the stock market, even commercial and residential real estate, a lot of these markets, these financialized markets, really focus on what's about to happen with Jerome Powell and the FOMC and the Federal Reserve, whether they'll hike or pause or, I don't even think this will happen, but sometimes they'll even reverse and go negative, but I don't think it's going to happen this year, but that's more for later. So let's get started. I'll set the stage for you. So right now, the top end of the federal funds rate is 5.0. So last time in March, the FOMC, the Federal Reserve presidencies, have gotten together and they felt in their vote that the interest rate should be increased one more time. Hence, later on today, we'll see how that works out. So the debate will be this. Will Jerome Powell let us know whether the 5.0% federal funds rate will that be increased to 5.25%? Or if Jerome Powell will share with us that there will be a pause and the US federal funds rate will stay at 5.0%. So we're going to look at some of the hints, some of the tips that the Federal Reserve has given us coming up to this meeting later on today. We're going to look at first President Bullard. So James Bullard is the St. Louis Federal Reserve president, if I'm not mistaken. Bullard does share that we do need to continue increasing the interest rates. His perspective is that inflation remains persistent and that the economy remains healthy. He finds that the labor market is also very strong. And because he believes that there's a strong labor market, that would feed consumption because people can generate cash flow or income to support their consumption. And because of this activity, he does not expect that there will be a recession in the second half of this year, right? So ultimately, Bullard does not expect the second half of this year, 2023, to have a recession. Let me know down below whether you expect a recession this half or if you agree with Bullard and you don't expect a recession this next half. So what's really interesting is the Federal Reserve as a whole does not agree with Bullard. In their last economic projection, which was released in the same date as the last meeting in March, they were or are actually expecting that there will be a recession later on this year. Which is interesting since Bullard does believe that the labor market is in good shape and the economy can handle that consumption. Well, there will be a demand for the consumption. And because of this bullish outlook he has, he's in favor of increasing the federal funds rate from 5.0% to 5.25% and later on today's meeting. So I think that's his vote. So next we have Loretta Mester. They are the Fed president of Cleveland. They also do find, like Bullard, that the inflation is stubborn and there is a strong labor market. And because of that, they will have to raise the interest rate by 0.25%, meaning federal funds rate will expand today and hit 5.25%. Her main focus is for inflation to be consistently on a downward path, and to help that, she will vote for an increase of 0.25. Mester finds that there has been a lot of improvements on reducing inflation, but she finds that core services in inflation has not really improved, which is a huge part of the problem. She does find that the market the labor market is strong, which helps, prevent the likelihood of a recession. But that isn't it. It's also a little bit more concerning for the Federal Reserve because a strong labor market also increases maybe wage competition, which may increase wages, thus down the line, increase inflation because people are making more money, have a consumer-based society, right? Here in North America, could increase prices. I also want to mention this that Mester has said, which is very important and is also very interesting, that the tightening conditions that banks, when they lend, has increased, and the tightening conditions from the Federal Reserve and central banks has also increased. That the tightening conditions of banks and their lending standards has lowered inflation, is more of a mechanism for reducing and bringing down inflation. Mester does find that after today's perhaps increase of 0.25, that the next meeting happening in June might not have an increase. And that's because even though the central banks might not increase rates again in June, she finds that, the regular retail banks are going to tighten their lending conditions, thus affecting and hopefully reducing the mechanism of inflation. In short form, I think what she's trying to say is that the retail banks are going to be doing most of the heavy lifting rather than the central bank. And lastly, I want to share with you the Federal Reserve of Atlanta, Federal Bostic. Federal Bostic is the president of Atlanta. Bostic finds that with one more move up for today's later on announcement is enough to help with the economy, and he wants to step back and see how that affects the overall markets. If the data comes in as Bostic expects after this increase, then he might hold off on perhaps changing the rates in next month's FOMC meeting. And upon monitoring this economy, he might not be in favor of increasing the rates again for maybe the rest of the year, which is pretty good. So overall, Bostic does believe that there will be an increase later on today for a 0.25 increase. And he most likely finds that that will be the last one. And if everything goes as expected with the debt market data collection, then there will be no pivot in 2023, which might happen in 2024 though. So those are some of the opinions from some of the federal bank members. I don't know if you agree with them or disagree with them. Let me know down below. I'm going to share with you now some of the external experts and what they're saying. So Bank of America, BOA, is expecting later on today another increase. Their global research team has shared that despite the improvements in March, that inflation is still too high. Now, Goldman Sachs does believe that later on today there will be an increase in rates, but it might be the last one. Goldman Sachs also believes that in June's meeting, there will be no increase in rates. So Bank of America, Goldman Sachs, most members of the Federal Reserve do project that in June there will be a pause in increasing or decreasing rates. It'll just be maybe 5.25. Goldman Sachs actually has a lot of overlap with what Mester has said, and that is that banks' tightening conditions for lending will be enough to help slow down the mechanism of inflation, and that the Federal Reserve won't have to do a lot of the heavy lifting. So basically, they believe that the banks will slow down the economy by increasing lending conditions and tightening it that way. But for full disclosure, I want to share with you some alternative ideas and opinions that are not exactly aligned with what we spoke about so far. Now, starting off with Citigroup, their chief economist is saying that later on today, the increased rate will happen. That's obviously not the difference in opinion. But for the subsequent meetings, the one that's happening in June and July, Citi is saying that if the labor market and the economy stays resilient and inflation persists, then we may see some increases in June and July's meeting. And Citi is saying this even though there might be tightening lending conditions in banks, it might not be enough to reduce inflation to where, the regulators want. All right, so that's Citibank. Now let me share with you what market expectation overall is. There's a very high, over 90% chance that the market believes that they will increase rates today. There's less than 10% chance that they will pause. Now, Because of this possibility, a very high possibility of rates increasing, it's already sort of been factored in by the markets. And, since it's been digesting since March, they've sort of anticipated that this will happen. So it's not really a boom in the market, but maybe because it was predicted, it shows sort of that continuity of we can predict what happens. Now, it is going to be more expensive to borrow, but at least things are flowing as expected. What this really means is in the markets later on today, what's going to be announced, and maybe even perhaps right after, is that the stock market and most markets are not going to have a correction or have a slight dip or a crash or whatever you want to call it. It's not going to go backwards severely. But that does not mean that it won't grind down slowly over the coming weeks and months because lending conditions, credit conditions are a little bit more tighter. Now, once Q3 comes, right, quarter three, that does not mean there won't be anything that's sort of unexpected or surprising. There definitely might be, and that might affect, but that's later down the road until we get there, though. There might just be a slow grind down because of the labor market, employment market might change a little bit and whatnot. And obviously lending conditions are going to be tightened by not only the increase in rate, but also by retail bankers as well. Overall, the market does expect in June that the FOMC, the Federal Reserve, the central bank, will pause and not increase rates to 5.5. They'll stay at 5.25. But there is like about 20% that the Fed isn't done yet, that they might increase another 0.25. Now, 28% isn't the majority, clearly. It is, almost a quarter of a chance, but that's not a thing to sort of scoff at. That means in 1 in 4 possibilities, in alternate realities, it will go up. So 28% is still not like a strong chance, but it's definitely a realistic possibility. Now, for the July FOMC meeting, the markets do believe that there will be a pause, whether the rates are at 5.25 after today or 5.5 after June. It doesn't matter. The markets do believe in July the FOMC will still pause. All right, so what does this mean in the long term? Say in September, that quarter three, right? The markets do expect that the Fed will pivot. If the FOMC tends to pivot, what that means is there's something in the economy that needs to change. So if the rates go down, lending conditions loosen up a little bit, QE, quantitative easing, and other backdoor indirect methods to increase the liquidity in the market would increase. But usually if this does happen and there is a Fed pivot, it's usually a sign there's something sort of cracking and breaking slightly in the market, and markets tend not to do so well. They tend to correct and start making a bearish move down. So just be careful, because if the rates do get cut in September's FOMC release, then that is my personal opinion. The market does expect a Fed pivot in September. So far, that's obviously can change because there's still a few months ahead of us. All right, so overall, for later on today, there's 8 things I'm gonna be checking. Number 1, that the market is correct, that there will be an increase of 0.25, and that the US Federal Reserve will increase rates from 5.0% to 5.25%. Number 2, that Jerome Powell will reaffirm that he's not expecting to cut interest rates in 2023. Even though the market might find that there might be a pivot in September, Jerome Powell will reaffirm that there will not be a cut in 2023. Point number 2. Point number 3, I expect Jerome Powell to also share with us that quantitative tightening, QT, is going as expected, and the data he has access to is supporting that theory. 4, that he's going to affirm again that the trouble we're witnessing today with banks such as First Republic Bank, SVB, Silvergate, you name it, Credit Suisse, are contained and under control, are not something that's a contagion across the financial sector. 5, that Jerome Powell will reaffirm that there is a strong labor market many times throughout his meeting today, and there should be nothing to worry about in terms of the labor market. 6, that when he gets asked about the high interest rates, he's going to redirect the question, not really answer it, but redirect the focus in saying that he will be data dependent and they will be analyzing and assessing the data as they collect it going on forward. 7, I don't expect Powell to be extremely dovish or extremely hawkish. And lastly, 8, I believe that Jerome Powell will be asked about the US debt, national debt ceiling that's coming up. And he's going to be apolitical, agnostic, really. He's going to try that his best compared to what a lot of us would think or like to say. That as a reminder that the Federal Reserve isn't a US government entity. It is a private entity as well. So he's going to step away from that and let the US government handle that debate. All right, so that's my overall thoughts and the opinions out there about what's going to happen in the market later on today with the rates. I do want to point out a few things as well regarding the stock market. The volatility index, the VIX index, is quite low. That means also that fear is low, volatility is low. A lot of the reactions we may be receiving will be a lot more subdued than what happened in 2022. So let me know if that's one thing that you also expect. So I would expect a boring stock market reaction after the meeting today because everything is as predicted. That is what I expect. So just keep that in mind in case you're doing any volatility plays, okay? And of course, I don't know if that's gonna happen, so we'll wait and see. That is for now, and let's go to the meeting. All right, so Jay Powell just finished his meeting and he answered questions that everyone had on their mind regarding when are these rates cuts gonna come? When are we gonna increase next time? How's the job employment labor sector doing? And how is this affecting the economy? What's going on with the banking crisis? All this was covered, so let's get right into it. So first things first, Jerome Powell did not hint at anybody cutting anytime soon. So that's a good thing, because if he did hint that people were going to, that they were going to cut, guess what would happen? You, your family, your friend's family, their friend's mother would all go and borrow money, take all that money, increase spending, right? So thank God rates are not being cut because people are going to be very excited. So that's a good thing that he didn't mention that there was going to be a rate cut because, we don't want more inflation. So that's good news. The rate was increased from 5 to 5.25 for the federal funds rate. That's the minimum that lenders will be able to borrow from the bank and roll that into the customers with their lending practices. According to Jerome Powell, this is and the market, this was expected. Not only that, the inflation rate, this will help slowly reduce the inflation by a stepwise measure. Nothing drastic should happen in the economy because he still anticipates that banks will tighten their lending conditions, which has a general broad effect, just like if the Federal Reserve or a central bank would to increase their rates for lending for these banks. So that is very positive according to the market because it's what you would expect. Nothing unforeseen came about in this meeting. Another great thing was if he also spoke about what happened if, hypothetical, if they were to reduce rates, we would expect in the market that everyone would go and borrow at these cheaper rates and they would go and spend it out there, hence causing inflation, especially with the service sector. He was very sensitive towards the service sector because the service sector, he saw that inflation is slowly getting better, but it's still high up there, still not where they want it at 2%. And so by the end of the year, they don't expect that to be dropping anytime soon. They want that steadily decreasing inflation to happen by having the rates at 5 or 5.25, and we'll see how that works out in the June and July Fed meeting. Now, he did mention a formula sort of to perceive when the rate cuts would be coming. All right, so the idea that he sort of shared with everybody was that his perception that inflation will not come down so quickly. What that basically means is this, where if the service sector is still perceiving inflation and it's going down slowly, why would there be a cut? Because at the end of the day, that would be very detrimental to the service sector industry. So they perceive the inflation to go down slowly in the service sector, and if they cut, that would create a lot more spending in the economy and those services would go back up. So he doesn't perceive a rate cut happening in the near term because he doesn't want to affect the service sector, right? His next moment that he shared that was very pivotal was when he said the next few months and their data that they would analyze would support the idea that their rate hikes and their performance in the past as the Federal Reserve was correct, meaning what they did in the past and what they're seeing in their future data was the right choice to make. So this is a good sign for the markets because this is considered bullish, where he's saying things that they have done and how they perceive their analysis in the future is actually good for the market. If the service sector doesn't get super hyperinflated and it continues to slowly be reduced in inflation year over year, that means not only would they be able to pause, but if there's a drastic reduction in services, they might, reduce rates so it's easier to borrow, thus bringing up spending in the service sector would receive that money, hence a little bit more inflationary. But they don't expect that. They're waiting. They're going to see how the service sector performs in the future, the next few months, because of the rate hikes that they did in the past. So this is all as expected, and they're very bullish on this. They're not saying like the economy is going to certainly change, but they want to wait. They need that patience and see how the future will perform in the short term, the next few months, because of what they have done. So overall, the markets are very neutral about this, but with a slight bullish hint in the air, So that basically means this. From now to the next summary of economic projections, we have a lot of data. And the first date I want you to take note of is this Friday. We get a jobs report. If it's anything like today's ADP report, that means no recession. That means jobs are flowing in like crazy. Now, even though there are some job losses that are like full-time with benefits and the job reports are saying, it's still strong, there's a lot of labor in the market and the, percentage isn't like drastic or anything like that. We just got to remember, guys, that a lot of full-time with benefit positions are being lost and people have to make up because of their costs, because of this inflation, by getting 2 or more jobs as well. So it's a little hard to gauge how tough this is going to be according to their view. So according to their books, it's not really affecting the market too much because people are working 2 part-time jobs or 3 or more to compensate for that full-time loss of job income. All right, so he also explained and shared with us that what the market can anticipate when he is thinking about reducing rates. And what he has shared was that inflation is gonna come down not so quickly, right? And so what that means is that slowly deteriorating rate of inflation, right? Slowly coming down to perhaps a 3% by the end of the year and a little bit lower by the beginning of 2024. Now, if that forecast is right, it would be wrong. It'd be very inappropriate to cut rates. So what that translates to is this. In the service sector, when you go to your barber, when you use Uber, in that service world for your day-to-day services, if inflation is sticky and isn't dropping quickly, it's that sticky one that's sort of being pegged down a little bit over a time, you can't cut rates, because if it cut rates, you go borrow money and you spend it at these services and it brings up inflation. So nobody's expecting the rates to be cut if inflation is sticky and prolonged. So the opposite would be this. If you do see a large reduction of inflation in the service sector, then the markets would start to anticipate the reserve to lower rates, right? Because it's dropping so fast, but nobody's thinking that. Unless the data comes out that way, but they're not anticipating the data to play out that way. So because the next few months are so crucial, that's something that he also relayed to us, that the next few months of data is crucial to how they have performed. So making sure that what they have done was right. Because of their rate hikes in the past, the future is as expected, and things are going according to their plan. So that's very promising. This is actually slightly bullish, meaning the markets can work with this and investors would definitely reap a little bit more benefit than they've anticipated. So basically, this is the takeaway. If the service industry, the service sector, inflation rate drops down quickly, then we know in these next few months, if that were to happen, that most likely the markets are going to project that the rates from the Federal Reserve will be cut. But as long as the service sector doesn't drop quickly in their inflation rate and it continues to slowly be sticky and slowly decline, grind the way down, as the Fed expects, then everything is going towards a soft landing, but that's still very optimistic, right? So far overall, everything is neutral with a tiny hint of bullishness in the market. So between now and the next summary of economic projections, we have lots of data, and I want to share with you some dates to keep in mind for the future. So this Friday, we get the jobs report. If it's anything like today's ADP report, that means no recession. That basically translates to jobs are flowing in like crazy and it's not, impacting the economy that badly. On May 10th, there's also CPI release at 5:30 in the morning. And then the second release of the CPI on June 13th, also at 5:30. And then the next Fed meeting after the 13th, happening on the 14th, is the next Fed meeting. That's when we'll know whether or not they pause or that they want to increase rates by another 0.25 basis points or 0.25%. So that's in about 6 weeks when we'll see Jerome Powell again. Overall, the market, and myself included, are of the opinion that, this is good for the economy because Jerome Powell has basically shared that they got it right, that what they were expecting with their rate hikes, even though it's unprecedented, in the last 14 months, they've increased it so drastically that at least the way the economy is playing out is what they expected, and the next few months worth of data will support this argument. So they didn't pause today, but he did speak about that potentially they are open to the idea of pausing rates in the future. Whether that be June or July or even September is unknown, but this is good because what they've done is increase rates to this point of 5.25, and they believe this is a good place to hold, or a little bit more possibly, but a good place to be at to help reduce inflation. Now with inflation being, slowly expecting to grind down, even though it's a little sticky, we did see when OPEC basically reduced the amount of oil they're producing, we saw a huge spike in oil, but now that it's come down, this will also reflect in the service sector as well, where things will slow down as well, which will help reduce inflation. He also did touch on the wage inflation. Now, wage have been rising to about 4.5%, roughly around there. He would like that to be a little bit lower to reflect a 3% wage raise to come closer to inflation expectations. So that is interesting because he's basically wanting the market to reflect that wages should come down to 3% year over year inflation to have the economy's inflation at 2%. So overall, this is really good for the economy because if we're at 5.25, the market is projecting that they expect rates to be at 5.08, meaning we've reached the top and things are only going to get softer in terms of prices because inflation is expected by the market to go down. Now, whether that's true or not, we'll only have to wait and see. So as rates have been increased to 5.25 and the expectation from the Federal Reserve that the retail sector of banks will tighten credit and borrowing conditions, this will help the economy fight inflation and help target that 2% in the long term by slowly reducing from where we are to where they want it to go. And the fact that, the labor market is finding unemployment, whether it be from full-time to 2 part-time jobs or more, the labor market is relatively low and the wage increases are not spiraling out of control, thus pushing prices up. People are earning and spending at a relatively modest rate because they have to still work, and prices are not being pushed up because service sector is still up there, highly inflated. And so as long as we see that slowly being fought and the service sector inflation still slowly come down with the wage and the labor market being very strong, it'll counteract that slow decline of the inflation, and they can project it. So it's really interesting because we have the central bank saying that they're almost done, if not close to the top of increasing rates. We have the retail bankers basically saying they're going to tighten lending conditions. The job market are still going to be not fully employed, but have a large number of employed personnel in society, and they're going to be spending it in the service sector, thus counteracting the reduction of inflation by pushing against it, trying to increase it. But because borrowing rates are so tough, that's going to put down on the amount people are going to be spending. Overall, the market is as they expected, and things are not as bad as they anticipate. They still do expect a mild recession, and according to Jerome Powell, a mild recession basically translates to a strong labor force during this inflationary cycle as well. What's also interesting that he mentioned regarding the labor market was the number of available jobs, let's say, is over here. What he said was, historically, when the available job numbers in the market goes down, generally you see unemployment rates go up. The less available there is, the more unemployment there is. What's interesting this time around that he mentioned and he noted was, if there's fewer jobs available in the market, this time you're not seeing unemployment go up. You're seeing that sort of stay. So I guess there's still that the unemployed are picking up jobs, and the ones that do have positions are staying in that role. And that basically supported his idea of saying that instead of there being a strong recession, that this will sort of counteract the possibility of even a recession, whether it be mild or not. So this is very promising. It does sound like he changed his view from there being possibility of a mild recession to the possibility that there might not even be a recession, but there's still that battle of inflation that they want to bring down. So that's why they increase rates today and hopefully hold that a little bit longer. Their hope is to bring down a sticky inflation slowly, even though the labor market is strong and there's no wage spiral happening. So that's very promising. That's what they expected and that's what they wanted. So in conclusion, with this increased rate hike that brings up the federal funds rate to 5.25, Jerome Powell has said that they're going to be watching the next few months, see how that data and their analysis of that data will look like. They're just going to sit tight and just basically analyze that, which is good for the market. It's what the market expects. And he's just gonna basically hang around, maybe ride his bike a little bit out there in nature and have a good time while the economy is softening and getting a little bit better. Ideally, if there's no recession, that's great. So on Friday, I'll also be releasing a CPI report just to share with you the information that is being released. And then from there, we'll move forward with other videos that might be very entertaining for you. So let me know down below what you actually think is going to be working out, if you think things are expected as we discussed in this video, or if you have a differing view. I'd love to hear you down. So overall, this was a very clear meeting and the report came out just as we expected. And this is very good for the economy because nothing black swanish came about. Make sure to like, comment, and subscribe, and we'll catch you guys later. Bye-bye.